Good morning, ladies and gentlemen. Welcome to today's webinar on the best of both worlds, the Sygnia ForLife Living Annuity. We will be discussing solutions and the history of some of the annuities in the South African market. So if we look at our agenda today, there's a couple of topics that I want to discuss with you. I'll give you some information on who we are, Just Retirement as a company, and how we got working with Sygnia in the post-retirement income space, what we've been seeing in the news in the last couple of months, and some of the research papers that's been floating around with regards to post-retirement income, the risks in the retirement that clients are facing, especially in today's times and over the last couple of years. We'll discuss a little bit of the inner workings of the Sygnia ForLife product, and we'll conclude with two case studies to see how this unique concept of blended living annuity, or the Sygnia ForLife Living Annuity, will contribute to the sustainability of retirees' income. A little bit more about Just. We're a wholly owned subsidiary of the Just Group, a listed company in the United Kingdom. And our main aim is to bring innovation into the post-retirement income space in the South African market, and to ultimately ensure that retirees do get a sustainable income. And by partnering with a company like Sygnia, we are able to introduce this innovation to create sustainable income into their living annuity. If you look at the current dispensation in the South African market, the retirees have the option to move into either a living annuity or a life annuity. Majority of the retirees in the South African market do move into living annuities. It's close to 88 to 90% in the current market environment. And a living annuity does certainly have some good advantages. You've got the ability to control your investments and your drawdown rate, or the income that you derive from your pot of savings. You're also able to leave some capital to your beneficiaries, which is a big driving factor in the South African retirees space. Some disadvantages is that your sustainability of your income is not always guaranteed. And in most cases, you need to hold back some capital in case you stay alive for a longer period. When it comes to transfer of monies, you are able to move from a living annuity to another living annuity provider in the South African market. You can also move from a living annuity to a life annuity. But once that happens, you need to move your whole living annuity, which creates some concerns for retirees in the current market environment. From a life annuity perspective, importantly, it protects you as a retiree and your income against longevity and inflation. It provides you with a lifelong income, even when you are possibly cognitively impaired due to medical conditions such as dementia or Alzheimer's. But there's some disadvantages as well. There's no fund value or no surrender value, and you forfeit the capital on death if you haven't added in benefits such as a guaranteed period or a spouse's pension. And this is one of the biggest drawbacks of life annuities. It's got the sustainable income component on the plus side, but on the negative side, there's some components on the forfeiting of your capital. When it comes to transfer of the monies, you are not able to move from a life annuity to a living annuity in the South African market. But ultimately, what we're going to try and address today is how the Sygnia ForLife Living Annuity how we can combine the benefits of the two products into a single product to ensure that we are able to get the best of both worlds. If you look at what's happened recently in the South African market, and one of the big driving factors behind guaranteed annuities is bond yields. So we've really been through these interesting times over the last couple of months. But if you look closely, there is a glimmer of hope with regards to bond yields. And this makes life annuities very attractive for retirees to introduce into their post-retirement income planning at this stage. If you look at July 2019, you can see the bond yields were trading around 8.2 to 8%. During COVID, or during the last couple of months, we did see a big spike in the bond yields, making life annuities very popular. And then over time, we have seen a decrease. But compared to last year and the beginning of the year, you can see that bond yields are very favorable still, and conducive for the introduction of life annuities into your living annuity. What we have been seeing in the market is this continued debate about living annuities or life annuities, and which one is the best. At Just, and I believe in Sygnia as well, we feel this is a very counterproductive argument, because the ultimate aim should be for the client to protect their income for as long as they're alive, and possibly leave a legacy for their children or beneficiaries later on in life. Where did this all start? If we go back to 2016, there was an interesting actuarial paper done by an actuary, John Anderson, and an employee of Sygnia called Stephen Empedocles. And they concentrated on a retirement income frontier and your application and construction investment portfolios at retirement. And basically what they did is focusing on what type of annuity to introduce into a living annuity that will lead to a higher success rate of protecting of your income. One of the main things that we will see, and we'll talk about this later, is that we want to protect clients, even if they become like Owen, where they turn 101 years old. We are seeing this on a general basis. Now, there's certain risks in retirement that retirees need to be aware of, and that's something that your financial advisor would have indicated to you over time. And some of those risks include longevity risk, investment risk, inflation risk, and behavioral risk. Now, for each and every one of these risks, there are tools out in the market that you can access within your living annuity to subside or protect you against these specific risks. Just Retirement did a survey. We've been running a retirement insight survey since 2015 with about 500 retirees. And we've asked them a couple of questions around what their specific needs and wants are in retirement. So if we elaborate a little bit more about this, you can see that if we speak about behavioral risks, it's interesting if we start looking at the needs and the wants and the requirements in retirement, you can see there that generating an income to pay for my regular bills for the rest of my life came out top. Typically, this would be protected by the use of a life annuity. The second component that came out second component is paying for long-term care. As you get older, your medical expenses increase, and the need for long-term care products or for a sustainable income to continue to pay your long-term care facility becomes more and more important. It was only on the third component that leaving money for my children and grandchildren is very important. And that typically, because of the flexibility of a living annuity, is where you will access the legacy component. The same happens with paying off your debts, such as credit cards or bond mortgages. With your retirement capital, you're able to do that by the use of the flexibility of your living annuity, either increasing or decreasing your drawdown rates. Supporting the financial needs of my partner came in as well. creating a component where you need to be able to sustain an income component, not only for yourself, but for your spouse. And in the South African market for the post-retirement retirees, in a majority of the instances, the spouse, being the wife, did not save enough to ensure that there's a sustainable income. And so that's very important, is to support the financial needs of your partner and ensure that they've got a sustainable income. The last one was paying for holidays, house repairs, and that's typically driven by a living annuity component as well. But if we dive a little bit deeper into this survey, the first thing and the most important thing of any retiree when they're either going to retire or are retired already is to ensure that they have calculated how much they will need in retirement. And based on our survey, we have extrapolated, and it's not only our survey, you would see this in if you look at some of the competitor companies and their research, that when it comes to budgeting or finding out how much money you need in retirement, 44% of the people have not done any retirement budgeting. Now, as part of the financial planning process of the independent financial advisor, they will take you through a cash flow analysis and assist you to set up a retirement budget to ensure that your capital and your income lasts for an extended period. If we look at the second risk, it's definitely inflation risk. It plays a leading role and a big role in the sustainability of an income of a retiree. The industry rule of thumb for a sustainable retirement is, if you look on various sources, we normally use about, for every R1,000,000, we are able to provide you with R4,000 of income. The median, unfortunately, in this Just Retirement Insights showed that the median in the South African market currently is about R8,000 per month. Now, that's been the case since last year already, and it's not just the impact of the fall in the markets or COVID over the last couple of months. But that highlights that there's some common misperceptions from retirees on how long your money can last. The other component is that when people retire, there is a need for higher drawdown rates in the beginning. And thus most people do expect a higher income or retirement income than what is sustainable. In the market, we refer to the 5% drawdown rule or the 4% drawdown rule, that if you draw more than that, you will run out of money, actually or mathematically, if you don't get the return in the markets. If you look at the latest statistics from ASISA, you can see in the South African market, the average drawdown rate is currently 6.6%. So in actuarial terms, that means that there's a high probability of people running out of money. Now, the requirements are also sometimes even higher than what the guaranteed life annuity rate can offer. And that's something that we can hopefully look at and contribute with regards to a blended living annuity. Most recently, the FSCA and ASISA brought out a draft on the living annuity standards and the drawdown rates. If you concentrate here on the left-hand side, this is the drawdown rate that they propose at the various ages that would create a 90% probability of financial survival. On the right-hand side here, they've got the maximum drawdown rate at certain ages that a retiree can look at, but that could possibly lead to a reduction in income or unsustainable income. So for a 60-year-old individual, you can see the drawdown rate currently is about 4.5%, with the maximum drawdown rate being around 7%. For most of the retirees, most of the new retirees we see currently retire between the ages of 65 to 70, And the drawdown rates that you can see there is 5%, and the maximum drawdown rate around 8%. Anything more than this would create a major issue within your specific portfolio. As you move up and older, you can see there's a range of drawdown rates that client needs to stick to according to the FSCA and the CISA to ensure a sustainable income and capital protection. On the right-hand side, we've plotted in some of the guaranteed life annuity rates. On age 65, you can see for a single male, the guaranteed annuity rate is 7.5%. For a female, it's 6%. In both instances, you can see it's more than what the drawdown rate is, or the sustainable drawdown rate is. And that's important. And in our case study later, I'll give you an example of the benefit of introducing a life annuity, or what we will refer to as Sygnia lifetime income, into your portfolio. The third component is definitely investment risk, and that's something that we've been seeing in the markets, not over the last, definitely coming to a point in March and April with the impact of COVID on the economy. But it's actually been something that's been hanging around in the South African market for the last 5 years. So the reality is that most of the South Africans that are currently retiring are probably finding their assets worth less than what they would have expected in normal investment conditions. But that leads us to another question that we've asked on our retirement insights. We asked the cohort of people with what amount of money are their funds able to fall before they are affected in terms of their retirement. And 40% of that cohort indicated that they cannot take a fall in the markets because that will drastically impact their income and their living conditions. The fourth component is around longevity and health. And as I referred earlier to my picture about Owen that's turned 101 year old, we are seeing an increase in longevity in the South African market, but also internationally. If you currently look at a 65-year-old male, the average life expectancy for a 65-year-old male in the South African market is about 83 years old. But if we do add some socioeconomic class, income, lifestyle, and medical conditions, and possibly a degree or a qualification, that client's average age actually jumps up to about 87. So if you look at this specific graph, you can see that at the age of 75, for a 65-year-old at age 75, 3 in 4 people of his cohort would still be alive. At age 82, 50% of that cohort would be still be alive, and so there's a big chance that a component of that cohort would reach the age of 95, and that's also typically the planning horizon that you as a retiree or as a financial planner need to take or need to be cognizant of. It's around 30 to 35 years that we are starting to see in the market. If you compare the life expectancy of males versus females, females do have a higher life expectancy in the South African market. And we do see, if you look at the old age homes or the retirement homes, we do see a bigger cohort of females in those homes. And the ultimate component being that we are getting older. Medical technology and medical advancements have put extra years on the retirees currently in the market. So as I mentioned, you can see longevity risk is even becoming a bigger concern for retirees. Majority of the clients or a lot of the clients that are currently operating within the just space are 80-year-olds that's concerned about their longevity. There's some biasness once people reach the age of 65, the expectation is to live longer. And every year as they increase, every year as they get older, that expectation just continues. If you look at some of the historical research, you can see that studies have now shown that we would live on average 10 years longer than our parents, and we will live double the amount of years compared to our grandparents. And this definitely plays a major role in financial planning for retirees. From an health impact, there's a big component internationally, or it's a big drive internationally to curb the onset of dementia and Alzheimer's. But it's definitely playing a role on your financial planning component. And in the US specifically, we've seen programs developed for financial planners to use with their clients to ensure that they are protected against these type of conditions in terms of your sustainability of income. But it's important for our retirees to be aware of dementia or Alzheimer's. There's a big genetic link on dementia and Alzheimer's in your family. So if there's a history, it's definitely something that you need to think about in your financial future. It gives you the ability to ensure that you'll make use of your own income rather than making use of your children's incomes or family members' income. The important component that we'll speak about later is that taking into account these health risks, there are certain companies, and we are one of those companies, that will underwrite you at retirement. It's a non-invasive medical underwriting, and ultimately what that would lead to is that we are able to increase your starting annuity on your life annuity component due to your lower life expectancy, because you possibly have some of these medical conditions that impact your life expectancy. So if we move into the nitty-gritty of this presentation, what can Sygnia do to protect you against these risks? Now, ultimately, what we can do from a Sygnia and a Jaco perspective is we can combine the flexibility of a living annuity and bring in the security of a lifetime income or a life annuity. And that gives you the ability to invest your savings properly, but also ensure that you are able to have freedom, knowing that there's a consistent payment of a life annuity within your living annuity, ensuring that you've got a sustainable income. If we look at the breakdown of this, you would see on the left-hand side, we've got the Sygnia ForLife Living Annuity. You still have access to your traditional investment portfolios, being a balanced fund, your equity funds, international equity funds, fixed interests. Even in the Sygnia example, you are able to access ETFs. But what we've done from our side is we've created a guaranteed income life annuity portfolio or investment fund. And by being able to do that, we are able to ensure that we are able to introduce a life annuity over specific times within your living annuity, ensuring a sustainable income. And that's ultimately the primary objective of this product. The primary objective of this product is to ensure that you can consume more in retirement and sustain this for life. Our secondary objective is to ensure that you maintain a reasonable death benefit or legacy for your beneficiaries. What you can do with this specific portfolio or the lifetime income portfolio is that you can add in a spouse's income. So anything from a 50 to 75 to 100% of income that would remain payable to your spouse for as long as he or she is alive. You can also add in a death benefit option called a minimum payment period or a guaranteed period, as it's referred to in the South African market, where all of your capital will not be lost should you pass away within year one. And the payments that we should have made to you can be paid for a 10 or 15-year period to your beneficiaries. It allows you to invest your savings, as we mentioned earlier, and you are able then to draw down on a much better ratio and a tax-efficient manner in terms of your retirement income. What this lifetime income portfolio does, which we commonly refer to as the Julie investment portfolio, it pays into your living annuity, as you can see there, and it's any percentage that you've chosen. That lifetime income can never decrease because of the nature of the life annuity component. It will remain payable for as long as you're alive or your spouse is alive. And this product targets inflation. Now, you can seamlessly top up your just lifetime income component at any time during a year. So typically, if you think about the bond yields that I've showed you, if you were in a living annuity, you were able to access that higher bond yields by moving a component of your money into the just lifetime income, Sygnia lifetime income investment portfolio, merely through the use of a switch form if you were already within the Sygnia living annuity. One of the components that we use when you talk about advice framework is referred to as essential expenses. And as part of the case study, I'll use essential expenses as part of the case study. One of the other components that we've introduced into the South African market is a component of underwriting. Now, when people hear the word underwriting, they immediately get this idea that about life insurance, all of the medical costs or the medical tests that you have to do. And firstly, I'll explain this concept of underwriting. Life annuities are based on working on your average life expectancy. But by introducing any one of these components, we are able to work out an individual life expectancy for you. And based on that payment profile, should your life expectancy have reduced from 82 to 80, we will increase your starting annuity. So if you've got certain lifestyle habits like smoking, or you've had a medical issue like a specific dread disease or a heart attack, you are able to do this underwriting, and this underwriting will play a role in your post-retirement income or sustainability of income. It's a 20-minute telephone call at the most to you and your spouse. There's no cost to the client or the advisor. There's no obligation to do it, even though it would only give you an upside and no downside. So there's no penalties should you, there's no penalties from our side. There's no paperwork. As we mentioned, it's a 20-minute telephone call, and there's no new medical tests or physical bloods that you have to do as a retiree. The best way to always explain a new product is probably through the use of a case study. And for this case study specifically, we've identified a typical married couple, which is age 65 and a 61-year-old female. And the aim for me in this example is to cover the essential expenses for life. Their current retirement benefit is about 6 million rand, with the investment approach targeting a moderate CPI plus 3% return. Their current required starting income is 300,000 rand per annum, or 5% drawdown rate, and the essential expenses is 150,000 rand. We refer to essential expenses as those expenses that you or your spouse cannot be without during your whole lifetime. So that's typically taxes, rent, bonds, cars, medical aids, those type of expenses. The required increase every year is inflation. And when we look at this, the main life expectancy of the client, of the husband, is 82, and their joint life expectancy is 93. The ongoing advice fee component that we've used here on this full living annuity, including the life annuity, is 0.5%, and the income requirement of the spouse is 100%. 100% payable for the essential expenses. And legacy for beneficiaries, what the clients want, if they pass away within a 10-year period, they want to ensure that the guaranteed income component should go to the beneficiaries for that period. So let's look at this graph. On the left-hand side, you've got your income component. On the right-hand side, you've got your fund value or your death benefit component. We've drawn this specific case study in real terms. This orange bar is highlighted by our essential expenses. So in this example, our essential expenses that we want to cover is 195,000 Rand per annum. Excuse me. The client's current drawdown rate is on 300,000. This is the standard living annuity. The yellow line is the average life expectancy of the main applicant. The purple line is the average life expectancy of the couple. If we look at interpret this graph, you can see we are able to sustain this income for a period of about 18 years, after which the client reaches the 17.5% cap. From there, there's a real drop in their income to such an extent that the spouse has just got above 100,000 Rand per annum left, which we normally see in the current retirement homes. On the right-hand side, a lot of people would think I'm starting with 6 million, and in real terms it would keep pace. But if you look over that extended 30 to 35 year period, legacy is definitely not a given. The question now is, what if we take a component of your money? In this example, I used 55%, and we buy a guaranteed annuity or a lifetime income component with it. Why I used 55% is, if you can see the pink coral line there, the pink coral line is the introduction of your guaranteed income. So you will never be able to get less than that pink coral line. And it's what we've done here is we've complied to the requirement of the husband to say that he wants to leave 100% of the essential expenses income to his spouse to ensure that she's able to cover those essential expenses. By interpreting the graph, I can explain the following. You would see there's a blue component overlaying the grey line component there. The grey line being your standard living annuity. As I mentioned, by the age of 90, there's just over 100,000 Rand left for the spouse. But by introducing a life annuity component, you can see that we are able now to sustain this client's income past the age of 90, after which they still hit the 17.5% cap. But by the age of 93, they have reached the level of the life annuity income, and they can never get less than that amount, and that will ensure a sustainable income for whoever is alive during that period. So at that age, we've got an amount of 195,000 per annum, compared to at 93, an income of about 70,000 Rand per annum, creating a big difference in terms of the sustainability of a retiree's income. A lot of the times when clients work with us, or they ask us the question, what about the capital? To ensure that you get the sustainable income for your spouse, you would release an initial capital amount compared to the grey line, which is your standard living annuity. Should you pass away in year one, you would see there's a component payable 4.2 million, of about 4.2 million to your beneficiaries. Should your spouse still be alive during this period, she'll continue to get the fund value there, that blue component, plus the 100% of the income that you've annuitized from the beginning. So that being an amount of just under 3 million, plus an income of 195,000 Rand per annum. Just to recap here, we've done these graphs in real terms. So if we did it in nominal terms, you would have seen increases, making a difference. Ultimately, as I mentioned, the pink line there, or the pink dotted line, is your guaranteed income that's payable for the rest of your life. So even should a client here start drawing 17.5% per annum, they will never be able to get less than that pink coral line. So how does Sygnia do this? Well, together with Sygnia, we've developed a solution. And when we looked at the solution, we started realizing that there's always this balancing act between income and legacy. So there's certain trade-offs that you definitely have to make. to ensure that you're either going to have a good starting income or a sustainable income, or possibly leaving a legacy at the end. But introducing a guaranteed annuity into your portfolio, you need to understand the workings of a guaranteed annuity and why this is such a beneficial product to add into your living annuity to create a sustainable income. For living annuity purposes, you need to be able to plan for about for a 65-year-old male up until the age of 95, for about 30 or 35-year period. That brings in a component of self-insurance, and you are only able to draw, if you look at the FSCA rates, about 5.5%, to ensure that by the age of 95 that you will still have a sustainable income. But when it comes to life annuities, we use the age-old adage of insurance, and insurance is a big cohort of people, and retirees are able to benefit of that cohort of people or co-retirees. One of the reasons for that is because as a 65-year-old male, if you look at the annuity rate, is 8%. An insurance company only has to price up until the age of 82 and not 95 or 100. That gives us the ability to introduce a higher starting annuity, and by introducing a higher starting annuity or an annuity rate, we are able to ensure that without taking any risk, clients are able to have a sustainable income. And by introducing this into your living annuity, you are then able to get the best of both worlds. What is the product that drives this special vehicle, or this sustainability of income? You would note, if you go and do some research, that there's various articles about with-profit annuities. And a with-profit annuity, in essence, is a guaranteed annuity product where we have got a component of money invested in bonds and a large component of money invested in a high equity balanced fund. In the Sygnia case, we make use of the Sygnia Skeleton 70 balanced fund. And based on an explicit formula, we are then able to work out the specific increases that clients would get over a 30 to 35-year period. What this product does over time, so the biggest or the largest with-profit annuity in the South African market is the Government Employee Pension Fund. And it's something that you can definitely have a look at. But when it comes to the Sygnia ForLife product, we've introduced this with-profit annuity with the future increases determined by the Sygnia Skeleton 70 balanced fund. We further bring in a smoothing component, so we just don't look at 1 year's performance. We look at a 6-year performance of that Sygnia Skeleton 70 balanced fund. And based on that component, we are then able to work out increases. The main aim of this product is to ensure that we are able to provide you with inflationary increases. And thus, we price this annuity to provide you with inflation in a CPI plus 4% investment environment. That means that if a product, or if this fund does CPI plus 4% over a 6-year period, you'll get inflationary increases. Should this product outperform, you will get inflationary increases plus. Looking at the historical track record of the Sygnia Skeleton Balanced Fund and the increases that we did hand out for the retirees that have already got a component in the Sygnia ForLife lifetime income portfolio, you can see since 2015, we've introduced the increase for a specific year was 12.81%, being cognizant that we take the previous 6 years worth of performance of that fund into account. 2016, you can see 11.07%, and most importantly, once I've given you an increase, this increase locks in and you can never get less than that amount. So if we start off on 10,000 and you move to 12,800, you can never be able to get less than the 12,800. If you looked at 2017, and that's about 5 years ago when we started seeing the struggle in the markets, there was a lower allocation to retirees of 3.39% and a little bit lower than inflation. 2018, we allocated 5%. 2019, 5.76%. And last year's increase, we allocated 6.7%, bringing the average increase over the last 5 years of the with-profit annuity within your living annuity to 7.45%. And you can see the average inflation over this period was 4.98%. I see there's a lot of questions and answers. What I'll do is I will, in the next couple of minutes, I'll go through that and I'll provide you with some information on your questions. Where we're not going to get to it, I'll answer you. I'll provide answers to Sygnia to send through to you guys. But let's just have a look at the traditional annuities versus with-profit annuities. If you look in the South African market, we've basically got 4 types of guaranteed annuities. We've got a level annuity, which is highlighted by the yellow line, which provides you with the highest starting annuity, but there's no future protection against inflation. You get fixed escalation annuities, which is highlighted by the black dotted line. And you can see that in 2005, it starts very competitive, but over a period, it provides you with a 6% fixed escalation. Inflation-linked annuities in the South African market, we are highlighting this here with the grey line. And over this period, inflation remained between 5 to 6%. The pink line here is the with-profit annuity. If we go and have a look at the markets, because your future increases are determined by a high equity balanced fund, smoothed over a 6-year period, you can see initially we start off lower, and during that period we do provide increases. Even during the 2008 financial crisis, we were able to generate increases, and over a 15-year period you can see there's been some good outperformance of with-profit annuities compared to any of the other annuities in the South African market. And as part of that research that Stephen Empedokles did, one of the things that they tested was what type of guaranteed annuity would fit within a living annuity to ensure a sustainable income component. So just to recap for the clients out there, what is then important? Well, the first step that you always need to be aware of is draw up a budget. Spend time detailing your needs and your wants to ensure that you are able to be aware of them. Step 2 is you need to choose an appropriate retirement product for each pot. So to cover your needs, a life annuity within a living annuity will offer you the peace of mind to ensure that you've got a guaranteed monthly income for those specific needs. Once, you can consider choosing an investment portfolio within the Sygnia ForLife Living Annuity that would contribute to providing inflationary plus increases for you. The third component is seeking professional advice. Retirement is not easy, and to make these decisions, it's definitely not easy. But what we have seen over the last couple of years is a cohort of advisors, professional advisors that's coming to the market and specifically concentrate on post-retirement income benefits. So they've become product specialists of the various options available in the market. And we've made a note here, and we said that, you know, if you would go to a medical doctor at age 60 because of some medical ailments that you've got, but you should be going to a qualified financial advisor to also understand the risks and the potential products that are available in the market for you as a retiree. There's been a big change in the market over the last couple of years when it comes to professional advice. I'm going to leave you with a last array before I'll get to some of the questions. And this is where we've really also seen this product coming to light. We refer to as the vulnerable widow. Currently, it's an age 75-year-old female. And yesterday in a webinar that I attended, apparently over the age of 75, about 80% of people still alive by that age are females. So the aim here is to provide her with a sustainable income and a possible legacy to her children or grandchildren, and we need protection by the age of 95. The current drawdown rate is 7%, although the FSCA requires 5.5%. She's got a pot of money of 3 million. Her life expectancy is 82. 13 years. There's no income requirement for a spouse, and she just wants to ensure that she leaves a legacy for grandchildren or beneficiaries. If we look at this component again, very importantly, if you look at that annuity rate, the annuity rate that we can offer at this stage is 9.14% compared to a drawdown rate of 7%. By introducing 50% of our money into a life annuity or the lifetime income component within the Sygnia ForLife Living Annuity, we are able to sustain her income from the age of 75 to about 96. That is 11 years longer than a standard living annuity. The reason for that is because the annuity rate is very competitive for that. So what we've done here is we've created a sustainable income. On the right-hand side, she also had the requirement that she wants to ensure that she leaves a legacy to her children. And you are able to do that through the way by using a life annuity within a living annuity. And to explain this, I'll use this component. The blue component is the 50% that's left in the markets. The pink component is your guarantee period that will still remain payable. Should this specific client live to the age of 95, where we need to have our planning horizon, you can see on the blue component, there's still a fund value left. Compared to the standard living annuity, which you are drawing down on a monthly basis, your fund value in a Sygnia ForLife Living Annuity is protected. One of the reasons why this is happening is because your annuity rate is more than your drawdown rate. You are drawing 7% in this example. So it starts building up a fund value for you, which is very important. Just a note from Sygnia's side, for the clients that are interested in this product, for direct clients, you are please contact your financial advisor, or you can email us at retail.sfs.sygnia.za, retail.sfs@sygnia.co.za. Sorry, my mistake there. And for advisors, if you are interested in this product, please have a chat to your business development executive, or you can also email us at retail.sfs@sygnia.co.za. I want to thank you for your time. I'm going to go to some of the questions to see what we've got available there. So I'm going to start with Omar. Omar, how would you structure this if you intend to live offshore? Your retirement money, unfortunately, one of the things that you need to look at, and I think we'll answer this for you later as well, is that before you move into a living annuity, because if you're in a living annuity with your monies, you can't move out. The only thing that you can do then, from an offshore perspective, is investing offshore within that vehicle. For Alan D, where can you see what your annuity rates are? The best way to find that, Alan, is by contacting your financial advisor, or if you haven't got a financial advisor, what you can do is you can contact us at that retail.sfs@sygnia.co.za, and we'll gladly assist you. I'm going to work through some of the other. So for Derek Jordan, Derek's asked here, am I able to select the investments underlying the high risk portion? You definitely are. You can, for the component of the monies that is driven by the life annuity, that fund that drives that future increases are the Sygnia Skeleton 70 Balance Fund. But for the other component of your monies, you are able to make a choice of your own funds. So you can do a 100% allocation there to any fund that you want to. For Mr. Jaco, the performance of the Sygnia skeleton pre or post costs, it's post costs. So I've taken out the costs, or I've already deducted the costs from my graph and the increases. For Prakash Van Malik, the question is the CPI the correct benchmark to measure against? My personal opinion, I don't think so. Inflationary for the South African market and inflation for the pensioner, in my view, is quite different. And that's why you need a little bit more aggressive fund to drive those future increases. If you look at something, for instance, like medical aid increases are 9%. It's not 2 or 3%. Over the last 10 years, it's been more than 9%. And that's typically what we need to look at for retirees to ensure that they are at least able to provide or cover their medical aid costs. So, yeah, Prakash, I think we need more than CPI. I'm just Lance, for Lance, yes, there are quotations available. You're more than welcome to contact us. What we have noted is this is a new product in the South African market. With new products, you create confusion. But the best way to do it is through meeting with us again. So we can definitely make contact with you, or you can make contact with us at retail.sfs@sygnia.za, and we can assist you to get to a better understanding of the product. For Jacqueline, Mika, I think that's a general question that a lot of people can hear this one. She said she once had a financial advisor that she only saw on an annual basis, and she wanted more from him in terms of service. The best way to choose an FA is through referral. Speak to your colleagues, speak to your friends. They will be able to provide you with information. Derek, yes, I did pick up there's one or two mistakes in my presentation. I apologize for that. It's something that I will fix on. For Troy Donaldson, are there any tools, calculators that just can make available to advisors? There's definitely this tool that we've made use of is called the Sygnia blending tool. We are definitely able to make that available to you guys. Contact your business development executive, and we'll be able to give you access to that. For Adrian, yes, definitely the same. Contact your business development executive, and I'll give you access. For Rita, one of the questions is a with-profit annuity a guaranteed annuity? It is definitely a guaranteed annuity. I'm just going to recap that maybe. A with-profit annuity is a guaranteed annuity, and the future increases are linked to a high equity balanced fund. So like a fixed escalation increase, you'll get, let's say, a 5 or 6%, you'll get that 6% for the rest of your life. With a with-profit annuity, your increases are determined by the performance of the high equity balanced fund. And based on those performances, we then allocate increases. So during good markets, you can normally expect increases more than a 5 or a 6% fixed escalation. The entry age for this product it's age 50. So clients are able to access this from age 50. If there's a younger spouse, we are able to accommodate. You are able to accommodate that. There's a lot of questions coming in. What I am going to do is I am going to copy these questions and put it into a FAQ for you, and we will provide you with the information based on that. So from my side, thank you very much for the opportunity. I truly hope all of you guys keep safe, and please make contact with us. Please make contact with Sygnia business development team. or contact them at retail.sfs@sygnia.za page. Thanks and enjoy your evening week.